The markets have opened at the beginning of the week, where on an individual basis, we are seeing some very mixed results. We have some notable companies, Palantir, Oracle up around 6%, as well as others that are, for the large part, down but only marginal. What's very interesting to see though, as we continue to climb onto new all-time highs on the S&P, that investors who had previously started to question the US market, believing it was overinflated and better opportunities elsewhere, for example Europe, are starting to consider whether that was the right option, and we could see a lot of money rotate out of Europe and back into the US. And it's quite clear we are sitting in greed, investor sentiment is very high, and whilst we would argue this perhaps isn't the best opportunity to buy undervalued stocks, the market doesn't care. We're continuing to move on to new highs. Now in today's episode, we are focusing on 6 growth stocks that could be a great option for long-term significant gain. One of them is in fact Grab Holdings, where we have a new buy just months ago from Howard Marks, a super investor, buying more than 10 million shares, and we're going to cover each one in a little bit of detail. Now before we do that, we're just going to discuss some market updates today. The first one, SoFi, is starting to break out. We're seeing it up more than 8%, which could lead to a new 52-week high. We also, as mentioned, have Oracle stock that was up and fairly decent as well. The markets have just opened, so this could go up into the double digit, and it isn't just this company. In fact, the good news that we can see here is that their cloud database is up around 100%, and that they're expecting a contribution of over 30 billion in annual revenue starting from 2028. That does really highlight the growth in cloud infrastructure, something that, as we can note here, is currently being captured by the likes of Amazon, Microsoft and Google. We also got to see Tesla make its first driverless delivery of a new car to a customer. That was fascinating to see and will be exciting to understand how the company will move on, and in particular Robotaxi and the expansion. But the company's share price has been suffering. In just the last week, it is down around 8%. Now if you remember, a few weeks ago we had news that potentially Amazon could be one of the bidders to buy TikTok, and whilst it doesn't look like they will be the one to acquire the company, Donald Trump has now said that a buyer has been found. We will hear about it very soon, and that the new owners will be a group of very wealthy people. So let's wait and see to understand who they are. And bullish news for investors who are very heavy in tech companies, a good way to think about how margins will be improved. For example, Salesforce CEO said that 30% of their internal work is being currently handled by artificial intelligence, and actually the CEO goes on to say it is doing up to around 50% of work, something that is not only bullish for Salesforce but also the likes of Amazon and others, where artificial intelligence is only increasing to help their bottom line margin and ultimately shareholder return. And you may have missed the news that Lululemon are suing Costco for allegedly ripping off their clothing designs. Now, you know Lululemon, their products, we're talking in the hundreds of dollars, and it's likely those same products or very similar are being sold at Costco for a much smaller margin. Now, it's not the first time we've seen something like this happen. We also noticed at the end of 2021 where Lululemon and Peloton got into a bit of a disagreement for something very similar. So it will be interesting to see where that ends up for both the companies. And moving on to Tom Lee, someone we do talk about from time to time, and actually looking specifically into crypto, we have MicroStrategy, where they're continuing to buy Bitcoin every single day. Well, Tom Lee is looking to create the same thing, but specifically focusing on Ethereum. Now, it looks like the issues that were in place between Canada and US to really get an agreement on the trade deal could be coming a lot sooner than we believed. Previously, there were issues. Donald Trump wasn't happy with the current situation, and it looks like Canada are rescinding on the digital services tax, meaning a trade deal could be announced very soon. We also have some very bullish news for Google, something we want to hear. This is one of the most unloved and undervalued companies in the market. They just signed the world's first corporate deal to buy Fusion Energy, securing 200 megawatts from a future plant in Virginia to power their data centers, and is also doubling down with fresh investment in the Fusion startup that is behind the project. Very bullish for the company. They're locking in clean, long-term energy for their AI growth while staying ahead in the race for sustainable technology. And like we typically hear every single day, Palantir with another contract. This one in particular, a major partnership with Accenture, making them the go-to implementation partner for US government AI projects, including over 1,000 of Accenture's staff on Palantir's platform to boost AI-powered solutions across federal agencies, and very bullish. It's strengthening Palantir's grip on high-value government contracts and scaling their artificial intelligence reach even further. Now let's dive into the 6 companies today. Jumping into stock number 1, we have Grab, and while Wall Street's staring at US mega caps, there's a quiet revolution happening in Southeast Asia, and Grab is leading the charge. Now, it isn't just a ride-hailing app anymore, it's food delivery, payments, fintech, and all-in-one super app with over 180 million users. And in quarter 1, while they posted record revenue, they turned free cash flow positive for the first time, and they continue to tighten their losses quarter after quarter. Now here's the kicker. As we said at the beginning of the episode today, Howard Marks, legendary investor and co-founder of Oaktree Capital, just added this to his portfolio. Now that's not a fluke. That could be taken as a very strong signal. And in a region with booming mobile growth, rising digital spend, could Grab perhaps be the next big global platform pay? And as we said, this could be one, given its size, to really grow extensively in a short period of time. Now we'll also show you once again Howard Marks quarter 1 2025. He added around 10 million shares to his portfolio, and it makes up around 1.2%. Although many super investors hold a wide range of stocks, so on the face of it, it may not look like a lot, but it's definitely a potential one to keep an eye on, as he could increase it in the next quarter. It's also one where we see 56% institutional ownership, around 1.5 billion worth of selling in just the last year, but a lot more buying, in fact just under 7 billion, and we see nearly twice as much buying in the most recent quarter, 586 million buys, 339 million worth of selling. In fact, a massive buy in quarter 4 with over 5 billion. It's also one that just last month Citibank maintained the buy rating. They see this as an intrinsically valued $6.20 stock, and it's also one where we note a strong buy rating from Wall Street as well as a double buy from both Seeking Alpha as well as Quant. Currently trading at the upper end of the 52-week range, a forward P that does look very high. We're going to discuss that in a bit more detail shortly. And in just the last year, up 44%, and year to date up around 8. Now in the last 4 quarters, we do note a 100% track record. They've either outperformed or, like the most recent quarter, they've been in line. And whilst we don't get anything for the next quarter, it does look like it will be very positive. As we can see, they're expecting earnings per share of 1 cent. In fact, if we look at quarter 2, it was actually negative, so a nice increase anticipated. And also, if we look to their next full accounting period, they're estimating 10 cents per share, lowering the forward P substantially to 47, and that is probably what we would say is their current forward PE. In terms of growth, they get an A+, revenue and forward looking around the 18 to 19% region, well above the sector that sits in the mid-single digit. And one thing that also looks very strong is their free cash flow growth, 73% over the last 12 months, and the same to be said to both operating cash flow, both on a year-on-year perspective and forward-looking, we're talking triple digits. In terms of profitability, they get an A+ overall, gross margin sitting at 41%, very nice, because the sector's not only lower at 31, but their own 5-year sits much lower at 6, so we're seeing efficiencies to their margins, something we always like to see. And this is something we want to come to expect from their bottom line, where it currently sits at below 1%. That is significantly lower than the sector at 6%, so ideally we see moving forwards gross margin increasing as well as their bottom line. Clearly, a driver of their profitability grade does sit at their free cash flow margin, which sits at 43%, well above the sector at 7%. Likewise, cash generated from operations just under 1 billion, a lot better than the sector at 338 million. But also notice this is a company that has historically been loss-making, negative 222 million over the last 5 years, now turning positive. This could be a very great potential play for some large gains overall. Now, before we get into the valuation, we also want to understand the underlying metrics. Free cash flow growth, as we highlighted earlier, did turn positive, and we can see that movement from negative in 2019 into 2024. Their sales growth has looked fairly strong, but also pretty inconsistent. Highs in 22 at 112% has started to come down. Definitely something we would say just to keep an eye on. And we notice over the last few years, their revenue has been growing, but at the same time, very important as well to incorporate in your own analysis, they have been diluting your position as a shareholder. Now, if they can massively outperform the S&P, maybe not a worry, but definitely something we do want to highlight. ROIC, now this is negative given they have been loss making, but we do anticipate this to turn positive. Great to see it is getting smaller and smaller. And then in terms of the margins, we can see their operating margin. Again, we do want to see this positive, something we do anticipate moving forwards. And their free cash flow margin, one of the main reasons we saw the A+ on profitability, sitting at 26% in 2024, on a trailing 12 month even higher at 28%. And probably our favorite metric of them all, the net debt to EBITDA, sitting at 0 on a trailing 12 month, expected the same over the next year, highlighting a very strong balance sheet, as this is the number of years, so not even one day, it would take the company to pay off all of their debt net of cash on hand. Now, our intrinsic value of Grab comes to just under $8, derived from the DCF model, where in fact we have the free cash flow year on year. Moving forwards, we have gone 10%. Now, that is at the lower end, as you can see, low, medium and high, 10, 15, 20. As always, numbers here are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Grab or any others. But essentially, 10% growth rate, 8% discount rate. We get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, 777, market price around $5, meaning 55% upside. Now, full transparency, if you believe that is too low, at 15%, 1048, indicating more than a double at 110%. And if we go even higher at 20%, 1425, indicating nearly a 3x at 185%. Now on the channel, we do want to be conservative. We are using the 10%, but you can see the different values and the upsides that would be obtained. In terms of where we get to now, we're not done. We like to start off with a 10% MOS, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that in the episode, a buy at $7, then we keep going till it's near the current trading price. And in essence, what we're saying today, you're getting quite a substantial margin of safety. Again, this on the assumption that you agree with growth to the future free cash flow at 10% moving forwards. 35% MOS, on average, price target sitting around the $6.20 that we saw from Citibank earlier today. 24% upside into 2026. Give us your thoughts on stock number 1. Also one Howard Marks has been adding. In your own opinion though, grab, buy, hold or sell. Now before we continue, we just want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox, where we go through severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to gain access to severely undervalued stocks for the month of June. We are dropping July's copy in the next few days. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then move on to Oscar Health, the AI native health insurance disruptor. Now, while legacy insurers are stuck in the past, Oscar Health is building the future, a tech-first AI native healthcare platform that's shaking up a $1.5 trillion industry. They're not just taking digital, they've also built their own insurance stack from claims to care, and in Q1 they didn't just surprise, they beat strong revenues, narrowing losses, and they raised guidance right across the board. And with rising margins, a clear path to profitability, and a unique moat in tech-enabled care, could Oscar be one of the most overlooked growth stories in the healthcare industry? Now, institutions hold around 76% ownership, where they sold $343 million in the last year. They've bought nearly 3 times as much at $905 million, and they've also bought more than they've sold in the most recent quarter. If we want to see the reversal of this trend, well, in fact, we can note you would have to go all the way to Q3 in 2022, where they sold more than they did in fact buy. We also note a huge buy in quarter 4. Now, insiders hold around 25% ownership, which is quite high, so we did want to bring that to your attention. However, whilst we get $5 million worth of insider selling in the last year, we get $14 million of insider buying. As we always say, insider buying, fairly bullish signal, and that is something we noticed in quarter 4. $14 million from management. Now, we actually get a double buy, although quant near strong buy at 4.5 with a hold from Wall Street. It is trading at the upper end of the 52-week range, a forward P that sits just below 30, and over the last year up 20%, year to date up a huge 56%. Now, over the next 4 quarters, they anticipate 3 of them to be growth. In fact, the next quarter up triple digit, although they have a 50% track record. Most recent quarter was a beat, trading on next full accounting period at a forward PE just above 17, and their growth comes in at an A+, revenue year on year 54%, forward looking 24, well above the mid-single digit of the sector, although it is a little bit slower than what they have done on a historical basis. EBITDA growth as well, very impressive year on year, 262%. Also EBIT growth 681, and their free cash flow growth sitting very strong at 50% when the sector sits lower at 11. Now, profitability does come in at a B, where their gross margin of 20%, a lot lower than the sector at 61, not far off their 5-year at 23. Bottom line, marginal 1%, sector a lot higher at 22. But nice to see a massive improvement from their 5-year average, where they were burning through cash negative 20%. And in terms of cash, they've generated more than $1 billion in the last 12 months, a lot higher than the sector at $151 million, and higher than the 5-year at $232. Now, their free cash flow growth is very inconsistent, as we can see, on a trailing 12-month sitting at $4.86. Sales growth very impressive, although a little bit of a slowdown from the triple digit in 21 and 22, now sitting at 54. And in terms of a numerical basis, while 2019 they reported $500 million, we now see the most recent quarter sitting at $9.2 billion. Massive growth. But likewise, the previous company, Grabstock, we do notice they have been diluting your position as a shareholder. ROIC, nice to note here, unlike Grab, it is positive, 3% in 2024, an increase to 8% on a trailing 12-month. And also nice to see, although very marginal, positive 1% on the margin in 2024, and free cash flow sitting at 11. Likewise though, with Grabstock, we do see the net debt to EBITDA at 0, so both companies very strong balance sheets. Now, our intrinsic value gets to just over $52. Bear in mind, a DCF model we have used, and in fact moving forwards negative 4%, so you could argue this in fact is incredibly conservative. But if you use negative 4, negative 2, even 0, we are looking at some very high upside. Negative 4%, $52, $148. If we go to negative 2, again, full transparency so you can see, $59, $181. And if you believe they won't increase their future free cash flow moving forwards, $67, 219%. We're talking more than a triple from today's price. However, extremely conservative, using negative 4%, getting to $52, we are talking about a very significant margin of safety, well above 10%. In fact, if we go to 50%, a buy at 26. If we look at 60%, around 21, that is where we see it today. Now, Wall Street themselves, lots of different price targets ranging from very low to very high. On average, it sits around $20, so they believe the company currently is sitting around this intrinsic price. Let us know though, maybe this is one you have on your watch list, maybe it interests you, or for whatever reason you don't believe it is a buy. We then move on to dLocal, the Latin American fintech powerhouse. Now, while everyone's chasing US fintech names, dLocal is quietly dominating emerging markets, powering payments for giants like Amazon, Spotify, and even Netflix across Latin America, Africa, and Asia. Now, they aren't just a middleman, they own the rails. One single API gives global businesses access to over 40 plus countries with local payments, faster settlement, and high approval rates. In quarter one, while they posted double-digit revenue growth, solid margins, and strong free cash flow, and Wall Street is barely blinking. Now, we also notice there is a huge total addressable market, high retention, and real profitability. So the question is dLocal the next global fintech success story hiding in plain sight? Now, institutions hold around 90% ownership with 120 million worth of selling, 154 million, so more buys overall. However, we do notice in the most recent quarter, they actually sold more than they did buy. Pretty much on a quarter-by-quarter basis, we do get inconsistency. There is no real trend. In fact, the vast majority of buying was in 2022, but always good to see the trends identified amongst institutions. We also have from April where JP Morgan cut their price target, but still fairly high in comparison to the value today, sitting at $16, where they do believe it will outperform the market. Now, we get a double buy from Seeking Alpha as well as Wall Street, trading around the midpoint of the 52-week range, a forward PE below 19, up 38% over the last year. Year to date, pretty much flat. And out of the next 4 quarters, they anticipate 2 of them to be growth. 75% track record. Nice to see. Most recent quarter was a beat. Trading on their next full accounting period at a forward P of 15. And growth where they do get a B+. Revenue year on year, 12%, very strong. Moving forwards though, they anticipate 23%, well above the mid-single digit from the sector. But actually, this company has historically grown very, very fast. And in terms of EPS projected moving forwards, 17%, higher than the sector at 10, but again, same story, over the last 5 years, it has sat higher. Now, profitability at a B-, gross margin sits at 41, that is below both sector at 61 and their 5-year at 47, bottom line around 19%, again, we do notice both sector and their 5-year high, so not something we ideally want to see in terms of margins decreasing. Cash from operations as well, 23 million, lower than both sector and their own historical. Now, free cash flow has been decreasing in the most recent year, although we do see it expected to improve, still negative, but improvement over the next 12 months. With sales also declining, still very strong in terms of the growth, 15%, but just a few years ago, we were talking about this company in the triple-digit region, with total sales expanding from 55 billion 2019 to now around 746. Yes, they have diluted your position, but at a very, very marginal rate from 275 to now sitting at 303. And when we look at the ROIC, really strong actually. Typically for any company, we want a minimum of 10% to give us faith management are able to effectively allocate their capital. Even with a decline, 21%, still very respectable. Now, operating margins, something we did just highlight, they have been decreasing, so we would say something to consider. And the free cash flow margin, we do want to see it go back up to the levels from just a few years ago where it was sitting very, very high. Now, net debt to EBITDA, definitely our favorite metric overall, 0 across the board. It won't even take this company, as we say, one day to pay off all of their debt, net of cash on hand. Now, our intrinsic price at $16, as we will come to show you, is derived using an 8% growth rate. Now, you could argue 6%, 10%, even higher. Each one does show upside, and we have used the 2025 free cash flow growth extrapolated for their most recent quarter. And again, we'll show you for consistency, 6%, $15, 36% upside, and at the 10% level, 18.25, 64. Now, taking through the middle rate at 8%, you are getting a margin of safety at 10%, a buy at $15, at 20 at 13, at 30 around 11.45, and we can see right now you're getting somewhere around 30 to 35%. Wall Street themselves, on average, $16 price target, that is upside of 45%. Give us your thoughts. Maybe you like some of these stocks so far, maybe you don't, but DLO, buy, hold, or sell. While the big cloud giants dominate headlines, Nebius is quietly building the backbone for the next wave of AI-powered businesses. They specialize in cloud-native software that enables companies to deploy AI workloads faster and more efficiently, And here's the kicker, they've just partnered with Nvidia, the leader in AI hardware and software, meaning they can offer cutting-edge AI acceleration, making complex models run smoother and cheaper for their clients, and they're also rapidly expanding, moving into the UK market to tap into one of Europe's biggest tech hubs. And with AI exploding in demand, Nebius positioned at the infrastructure core, this could be a great play on the AI cloud. Now, as we said, it wasn't that long ago that they were backed by Nvidia, and it's also one that institutions hold around 22% ownership. In fact, they haven't sold a single share in the last year. They've bought around 923 million, with the majority of that coming in just the latest quarter. Now, the company is up 187% in the last 12 months. Year to date, nearly a double at 97%, and currently trading at the upper end of the 52-week range, with a strong buy from Wall Street, 4.75 out of 5, and a buy from Seeking Alpha, although we should make you aware it is currently loss-making. Earnings per share as well moving forwards negative 1.4, and that, as we can see, is expected to continue over the next few quarters. And they don't have one of the best metrics, at least for the time being. As we can see, very inconsistent free cash flow per share, the same to be said on their top line sales. However, we do notice their shares outstanding has been decreasing. They've been doing some share buybacks, going from 324 million 10 years ago to now sitting at 238. When we take a look at the ROIC, not something we typically want to note. In fact, it's gone the other way. What we'd ideally like to see here is negative moving to positive, where it has gone the other way, now sitting around negative 11%. And that is also reflected on their margins, negative through both operating and the free cash flow. Net debt to EBITDA also on the higher end, although a lot of capex is being spent, and they do anticipate this will really drive growth moving forwards. Now, getting to our intrinsic value of $67, we have used a growth rate moving forwards of 25%. However, if you do believe it should be lower at 20, then in fact we are looking at downside intrinsically $51. If you believe it should be higher at 30, then it will get to 87, upside of 61%. So using the 25% growth rate, what we can in fact see here is that you are getting a margin of safety, 10% a buy up to $60, at 20, pretty much where we see this company now. Wall Street themselves see this at $67 into 2026. That is upside of 24%. One that institutions are starting to ramp up in terms of their purchase. We also saw Nvidia too joining along, but let us know your thoughts. Nebius, is this one that has already made its run, or do you believe long-term growth is still there, both on their numbers and in terms of their share price? We then move on to the global leader in language learning technology, that is Duolingo. While education technology is booming, Duolingo stands out as the most popular language application worldwide, with over 60 million monthly active users, and this is growing fast. Now, they've mastered gamification, AI-driven personalized lessons, and they're now expanding beyond language into literacy and math, aiming to be the go-to leading platform for everyone. And in recent quarters, they've shown strong revenue growth, improved monetization, a growing subscription base, all while heavily investing into AI to make learning smarter and more effective. Now, with a global push into new markets and education's shift to digital, Duolingo is more than just an app, it's a platform transforming how millions learn. Now, institutions hold around 92% ownership, where they've sold 2.2 billion in the last 12 months, buying nearly 50% more at 3 billion, and we can also see more buyers than sells in Q1, fairly even in Q4, and the reverse of the trend noted in Q4 2023. It's also one that JP Morgan just this month increased their price target to $580. As we mentioned, growth continues to shine through very strong, and we also get a double buy from Seeking Alpha as well as Wall Street, trading at the upper end of the 52-week range. Now, over the last year, phenomenal, up 113%, and year to date up 28%. Now, over the next 4 quarters, at a bare minimum, they're anticipating double-digit growth to EPS, with a 75% track record, most recent one being a beat, and based on their next full accounting period, EPS 444, Forward P, which does look very high, sits at 93. Some people could argue that it's justified based on the growth. And speaking of, they get an A+ pretty much right across the board. Year on year, 39%. Forward looking, 34%. Well above the low single digit of the sector median. But we do notice historically they have grown at a faster rate. No matter which growth metric you look at, looking incredibly impressive, with anticipation of EPS moving forwards at 54%, when we can see here sector much lower at 10%. Profitability also good at an A, gross margin 72%, well above the sector at 38%, pretty much in line with their historicals. Bottom line 12%. Again, above sector, but not only above their historical 5-year, before they were actually making a loss, -7%, so very impressive to see that transition. And cash generated 308 million, little bit higher than the sector at 288, and a lot higher than their own 5-year. Now in terms of their metrics, free cash flow looking very nice. We get that consistent growth for the large part that we want to see, expected to continue over the next 12. Sales growth, whilst it has slowed down, not that much. We're talking in the 40s over the last few years. And from a numerical standpoint, very, very strong. We're talking more than 10 times in just a matter of years from 2019. Again, like the majority of companies today, they have diluted your position over the last few years, but share price performance, at least for the time being, does look fine. In terms of ROIC, good to note, 6% and positive in 2024, an improvement from the previous year, and in fact, year on year, it has been getting smaller. Nice to see that positive momentum in 2024, and the same that we can see on their margins, now positive, sitting at 9%. Free cash flow, very strong, 38 in 2024. And then we finally move to the net debt to EBITDA over the last few years and expected moving forwards, sitting at 0. Remember, correlates to a very, very strong balance sheet. Now, our intrinsic price gets to $403. However, we have used a 20% growth rate moving forwards. If you believe it should be higher at 25, then it's upside of 34%. Otherwise, what this pretty much means, given it's not that far off, already baked into the numbers for this company is 20% moving forwards, trading then at a very marginal premium. Now we'll show you for those that want this at 10%, a buy at 362, at 20, 322, and at 25, 302. But Wall Street, they disagree. They see this $550 on average into 2026, upside of 32%. Now that pretty much means they see around 25% to the growth rate moving forwards, as that is where the value sits. So we'll also highlight for those that are in agreement with Wall Street analysts, the margin of safety that you are looking today. At 10%, a buy at 500, at 20, 445, at 25, 416. So pretty much right now, analysts see this at a 25% MOS, but give us your thoughts. Duolingo, buy, hold or sell. While everyone's focused on traditional cloud giants, Iron is quietly building Europe's next-gen data centers, powered 100% by renewable energy and optimized for AI and high-performance computing. They're rapidly expanding their capacity, aiming for 910 megawatts by the end of the year, with flagship projects like the Horizon 1 AI data center, which is set to launch soon. Now, what sets them apart is their cutting-edge facilities. They support power-dense workload, including NVIDIA's latest chips, perfect as well for crypto mining, AI training, and cloud services. And in a world hungry for sustainable, scalable infrastructure, Iron is positioning itself as a critical player in the booming AI and crypto data center market. Now, institutions hold 41% ownership, where they've sold 57 million, but bought a lot more in the last year at 301, something we also see in Q1, large buy as well in Q4. In fact, quite a consistent theme throughout. If you wanted the reverse of the trend, only marginally Q3 2023. Now we get a strong buy from Wall Street with a buy from Seeking Alpha, trading at the upper end of the 52-week range, up 17% over the last year, year to date as well up 54%, and they do expect growth in their next 4 quarters. However, they do have a 25% track record, only one beat in the last 4, most recent a marginal miss, trading on their next full accounting period at a forward P of 13. Now growth looks very strong at an A+, we're talking triple digit year on year, triple digit forward-looking. EBITDA growth also the same on both a year-on-year and again forward-looking basis, and that is something very consistent even against their own 5-year average. But profitability does come in at an F, whilst their gross margin sits high at 92%, well above the sector at 50% and even above their 5-year at 85%. Their bottom line comes in at a negative 9% when the sector sits positive 4%. We do also note cash generated from operations is actually in the negatives, 211 million versus positive 117 for the sector. And when we take a look at their underlying metrics, we are seeing negative free cash flow. In terms of sales growth, as we highlighted though, triple digit every single year. And from a numerical standpoint, well, they reported 2 million in 2020, most recent annual accounts 189, anticipate to go even higher as we can see from the trailing 12 month. However, as consistent for the large part today, they have been diluting your position as a shareholder. In terms of ROIC negative, as we highlighted, it is currently loss-making, which is also reflected on the operating margin. Net debt though looking fairly strong, 0.87, and anticipated to come down to 0.31. Now our intrinsic price gets to $19 today, where we have used an estimated future free cash flow based on analysts at 60 million. In terms of the 25%, you can see that would be upside of 27%. If you were to use a lower rate today at 20, that wouldn't be that far off, so you can say already baked into the numbers is 20% growth. At 30, even higher, 73%, as we will show you here, coming intrinsically to $26. So if we use the middle rate of 25 today, we can in fact see here you are getting a margin of safety, 10% a buy at 17, at 20 around 15.47, and at 25 not quite there yet, sitting somewhere 20 to 25. Wall Street pretty much in agreement. They see this at $19 into 2026, upside of 27%. As always though, let us know your thoughts on this company as well as others, whether you see them as a buy, hold or sell, and if you believe some of these have the capabilities to really grow rapidly very soon. Don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our buys and sells, and as always, have a great day. We'll see you all on the next one.